Hello and welcome to Chapter 2, and we're going to look here at financial markets and institutions. So we're going to talk about the capital allocation process, or how capital, or things like money and equipment which are used in production, is allocated, various types of financial markets and institutions, the stock market and its returns, and finally, are stock markets efficient? And a lot of this stuff we are going to compound upon quite a bit as we proceed through our class and look at a lot of these topics individually. So how is capital transferred from savers to borrowers? So saving is anytime you put away money, and borrowing is anytime you borrow money from someone else to use, in this case, in a business sense. So it can be from direct transfers. You can loan your money to a business. You can do things like purchase a bond, or flat out grant a loan to a company or something like that. They can be facilitated through investment banks or other financial intermediaries as well. So in a well-functioning economy, capital flows efficiently from those who supply it to those who demand it. So there are lenders and there are borrowers. Your suppliers of capital are individuals and institutions who have excess funds. If you have money you're not using, you can loan it to someone else for some sort of a rate of return. You're not doing it out of the goodness of your own heart. You're doing it to make some sort of a return on your money. So these groups are saving money and looking for a rate of return on their investment. You have excess funds, you can lend it to someone and make interest on your money. Your demanders or users of capital, these are individuals or institutions who need to raise funds to finance their investment opportunities. And these groups are willing to pay a rate of return on the capital they borrow. So anytime you borrow money, you have to pay some sort of an interest rate. You can't just borrow money for free. So you're willing to pay that rate because now you have money that you can utilize for things such as funding a new opportunity. What's a market? A market's a venue where goods and services are exchanged. So a market is a venue where goods and services are exchanged, and they can be things such as financial markets. The stock market is an example of one. And this is a place where individuals and organizations wanting to borrow funds are brought together with those having a surplus or excess of funds. So it brings people together, and you can borrow funds and loan your funds. So there are bond markets, stock markets, all sorts of types of financial markets. And we're going to look at what those are on the next slide. So of our financial markets, we have the following. We have physical versus financial assets. Physical assets are something tangible that you can touch. So any commodity, oil, gold, those are all examples of physical assets. Financial assets are things like stocks and bonds. They are not something tangible. You have money versus capital. So money is money. Capital are things such as capital goods. Primary and secondary. So primary markets are the first transaction. So if a company issues new stock shares and you buy them, that's a primary transaction. If you log on your broker and buy existing shares of Apple to add to your portfolio, that's an example of a secondary. Public and private. Public would be between things such as the government, or markets that are open to the public, and private markets are ones that not everybody can utilize. And spot markets are markets where things are priced right now, and futures markets are pricing in the future. Commodities markets often use futures. When you trade oil, for instance, you purchase the right to buy oil on a certain date at a certain amount. That's an example of a futures transaction. Why are financial markets important? Because when they function well, they efficiently facilitate the flow of capital from investors to the users of that capital. Markets provide savers with returns on their money saved, invested, giving them money in the future. Once again, you don't lend your money out for free. You're lending it out for a rate of return, and that's going to earn you more money to utilize in the future. And they provide borrowers or users of capital with the necessary funds to finance their investment projects and keep their businesses running. So markets are essential to economic growth. Economies break down when you do not have functional financial markets. because the money flows from from savers to borrowers in a circle and allows the economy to keep working. Economies with well-developed markets perform better than ones with poorly functioning ones. Poorly functioning markets are a hallmark of a dysfunctional economy. What are derivatives and what can we use them for? Derivatives are a type of financial instrument, and they are derived from the price of another security, hence the name derivatives. A big example of derivatives are stock options. Stock options give you the right to buy or sell a stock in the future at a certain price. So there are call and put options. Call options are if you expect the stock to go up, puts if you expect it to go down. Both of them, when you initially buy them, really aren't worth anything. If you buy a call, you get the right to buy a stock at a price that's higher than it currently is. If you buy a put, the right to sell a stock at a price lower than it currently is. But you hope the stock moves in a direction that makes those options valuable. And that is why it's known as a derivative. The price of the underlying stock is determining the price of those options. Futures work similar. The difference is futures pertain to commodities such as gold or oil or anything like that, whereas options pertain to stocks. We can use them first off to hedge or reduce risk. An importer whose profit will fall when the dollar loses value can purchase currency futures that do well when the dollar loses value. So even though his business may get affected, he may make money from those futures, offsetting some of his losses. That's an example of a hedge. It costs you money to buy those options, so if you don't need them, you're going to lose money on them, but it also offsets a lot of your risk. So a lot of investors will do this. A lot of speculators will trade derivatives as well, betting on the direction of future stock prices, interest rates, exchange rates, and commodities. And you can make a lot of money if you guess right, but also lose a lot of money if you guess wrong. So they are a form of gambling. They can increase risk, but you can get large returns if you get it correct. So derivatives are important because they can be used in a hedging manner and also in a speculative manner. What are some types of financial institutions? So some types of financial institutions are the following. We have investment banks, and investment banks, once again, are not banks that you would go to open a checking account for the most part, but they do things like facilitate stock issuing. They help companies sell themselves in things like mergers and acquisitions. They help companies go public, meaning when a company is going to issue stock for the first time, they can facilitate bond offerings. So investment banks have a lot of involvement in operations of companies in addition to issuing financial products of their own. Commercial banks are banks that you would have a checking account, a savings account, a credit card from. These are the banks catering to retail clientele. Financial services corporations are large conglomerates that are offering all sorts of different financial services in-house. Your largest banks are these, so they have investment divisions, they have commercial divisions, things like JP Morgan Chase or Citigroup. These are financial services corporations. They may sell insurance products. They are going to be basically many stops under one roof, offering all sorts of different financial services and products. Pension funds are for employee retirement at things like corporations or municipalities. You pay into a pension fund, and then the fund manager invests all that money in investments that will hopefully grow, so the company can pay out its pension obligations. You retire and you collect a pension. That's being funded by the pension fund. New employees pay into it, the old employees get paid out, and it's invested in various things to grow. Pension funds often have caveats of what they can invest in due to that reason, because they are directly tied to individuals' retirement. Mutual funds are funds that generally will invest in things like a broad amount of stocks or sectors, or they can invest in bonds, they can invest in all sorts of things. And you can give your money to a mutual fund, and the mutual fund will add your money to the pool, and that pool will purchase all sorts of different financial securities. And once again, with the goal of growth, if your mutual fund does well, your investment goes up. So mutual funds cater to the general public, and you pay money into the mutual fund and they invest your money. And they take fees, obviously, to do this. Exchange-traded funds are similar to mutual funds, but unlike a regular mutual fund, you can easily buy and sell them on a stock exchange. Just like you can buy shares in Apple, you can buy shares in an exchange-traded fund. Otherwise, they're very similar to a mutual fund. They take all of their money and pool it together and invest it in various things, but they are easier to buy and sell than a traditional mutual fund. You can freely trade them on a stock market. There are many examples of those. There are ones that do things like track the Dow and S&P, and then there are many specialized ETFs in all sorts of different sectors and things like that. A hedge fund works similar to a mutual fund, but hedge funds cater to generally very high net worth individuals. Their original purpose was to hedge risk, but now they are generally speculative trading funds, and there are many types of hedge funds. The difference between them and a mutual fund is they're often a lot less regulated, because most hedge funds will not allow people to invest unless they invest multiple hundreds of thousands, if not millions of dollars. They're catering to very select, very high net worth individuals, and as a consequence, they don't really fall under as many regulations as mutual funds. The general public is not really able to invest in hedge funds. They're very selective of who can invest, and you need generally a large amount of money. And private equity funds, these are funds that pool together large amounts of money for the goal of buying and selling companies. They'll buy distressed companies and flip them or run them. And private equity funds operate in that manner. They use a large amount of cash that they raise to do things like purchase a company that's teetering on the verge of bankruptcy, to fix it up or sell it for pieces. And we'll get into all of this when we look at mergers and acquisitions. Stock market transactions. Let's say Apple is issuing an additional stock with their investment banker helping, so an investor purchases some of the new shares. Is this primary or secondary? That's a primary market transaction. Why? Because they're brand new shares. They've never been sold to anybody else. If you buy them, you're the first owner of those shares. Primary market. If you just log on to your Schwab account and buy some Apple stock because you want to add it to your portfolio, that's a secondary market transaction. No new shares are being created. You're purchasing them from someone else who had sold them. So, no new shares were issued. You're buying existing shares just from someone. What's an IPO? An IPO is known as an initial public offering, and this is when a company issues stock for the first time. Companies generally start off as private companies, meaning they are a corporation, but you can't buy stock in them. And when they hit a certain point, a lot of them choose to go public because it allows you to raise more money and grow more. So going public enables a company's owners to raise capital from a wide variety of outside investors, and once issued, the stock now trades on the secondary market. So once you go public, you can raise a lot more money than you generally could have before. The downside is you're subject to a lot of additional regulations and reporting requirements. There are a lot more accounting rules that you have to meet, a lot more reporting, publishing with the SEC that you're issuing stock. There's a lot of regulations. You can't just issue stock and do it in a day or something like that. So there's a lot more red tape. However, it allows you to raise a lot more money. And most of your large corporations that you know are publicly traded. Anything you can purchase stock of in your brokerage account is a publicly traded company. Here's just an example of the S&P looking at total returns. So there were down years. The most recent really large down year was the Great Recession of 08-09. And looking here, this data stops at just before COVID. Then you would have saw a large down year in 2020, followed by a return to up years. So this is just a snipping of some returns of the stock market. Some years did very well, some very little change, and others large drops. This is a nice little snapshot of the past because Twitter no longer publicly trades. Twitter was purchased by Elon Musk around a year ago and is now a private company. He bought all of the shares of stock outstanding and the company went private. We'll get into how that occurs once again later on in the course. But in 2020, on March 27th, this was a historical quote for Twitter. It was trading at $24.98 a share. And this was what they were trading at on that day, down 5.43% or $1.43 in dollar value. And we're going to get into how to read stock quotes more when we look at the stock chapter. You can find stock quotes everywhere, online, print sources, and generally we look at them online in real time. So this is an example of a stock quote. It shows you both the change in price and percent. Since both of them are red, it means the company was down on that day. And Twitter does no longer trade. Twitter is now a private company, and it has since been renamed, I believe, to X.com as well. What is meant by stock market efficiency? Generally, we say stock markets are fairly efficient. Securities are normally in equilibrium and are fairly priced. And investors cannot beat the market except through good luck or better information. Better information, if you have some sort of inside information, obviously insider trading is not legal, but if you do, then you have information that other people aren't privy to. So obviously, you can trade in your best interest. If you know a company is going to go bankrupt tomorrow and they haven't announced it yet, you can use that to make yourself money. But generally, if we look at the overall market, we would say the market's efficient, but there are periods where stocks do trade where above or below what they're really worth. So what do we mean by the efficiency continuum? Generally, really small companies that most analysts don't follow, that aren't in the news, they can be very inefficient in how they're priced. They could be a lot lower or higher than what they're actually worth, their intrinsic value, because not really many people are paying attention to them. The really large companies that we all know, Apple's, Microsoft, all of those are generally pretty efficiently priced. They're followed by tons of analysts. They're always in the news. Good communication with investors. So that is what we mean by the continuum. Really large known companies are generally display a higher degree of efficiency, and are they priced at what they're actually worth, than small ones or companies that people don't really think about. What would the implications of this be? You hear in the news that a medical research company got approval for a product. If markets are highly efficient, can you expect to take advantage of this information? The answer is no, because if the market's efficient, the second that information comes out, the price of the company is going to jump. And you see this all the time with stock prices. If information comes out positive or negative about a company, you'll see the price either jump or plunge pretty much immediately. So if the market's efficient, this information's already in the price. So it's probably too late to capitalize on it. Once again, if you had insider information the day before, knowing this was going to get approved before anybody else did, then yes, you could make a lot of money. That is, however, illegal. But in an efficient market, the second that news hits the wires, the price is going to change. Now, what about IPOs? A small investor is reading about a hot IPO going public later this week. She wants to buy as many shares as possible. Would you advise her to do this? Probably not. The long-run track record of hot IPOs is not great. Usually they stay flat, or if anything, they may drop unless you get in on the ground floor and get shares before it starts trading. Because once an IPO is announced, it's going to build buzz immediately, and IPOs generally run up in the beginning and then settle back down to earth. Not always, but a lot of times. And it's usually hard for small investors to get shares of hot IPOs before it starts trading. By the time it goes public, a lot of people already did get shares, company insiders, things like that. So keep that in mind. That's another implication of market efficiency here. Now, what are some possible implications? This is going to be our last slide of the chapter. So it's costly and risky for traders to take advantage of mispriced assets. So if you do find an asset that's mispriced, obviously you can make a lot of money, but if you're wrong, you can also lose a lot of money. So cognitive biases cause investors to make mistakes that lead to inefficiencies, and this is an area known as behavioral finance. If you ever do plan on going into the realm of finance, I would highly recommend taking a behavioral finance class. They're very fascinating. They combine points of psychology with finance and how people make decisions and why they make decisions. So it borrows insights from psychology to better understand irrational behavior and how it can be sustained over time. So some examples include evaluating risks differently in up and down markets. If the market's running really hot, it's doing really well, investors are generally a lot more inclined to invest in incredibly risky, dubious companies than if the market's doing poorly and they're down a lot in their portfolio. So people don't evaluate risk the same depending on how well they're doing. Think of gambling. If you're doing really bad in a casino, you may walk away or you may double down. Generally, if someone's doing really well, they may start throwing money on incredibly risky bets, thinking they can't lose. The same thing happens a lot of time in the market. Whereas if someone's taken large losses, they may become a lot more averse to risk. Investors become anchored to certain viewpoints. You get stuck in your ways, and you fail to respond to new information that might conflict with it. Your viewpoint may have been right in the past, but things change. And if it's no longer correct and you can't give that viewpoint up, you might wind up costing yourself money or making poor decisions. So behavioral finance is very interesting. It's something I would definitely recommend to take a class in if that's something you're considering going into in the future. And that's going to take us to the very end of the chapter and our last slide.